This is a 10,000 yen note, about $64 at today's exchange rate. Looks like money, feels like money, spends like money. But here's what's strange. The institution that prints this note, the Bank of Japan, just did something that hasn't happened in 40 years. They sold American debt. Not reduced their purchases, not slowed accumulation. Sold. $890 billion. Liquidated. In 11 weeks. That's not a policy adjustment. That's a controlled demolition. For 6 decades, Japan has been the most reliable buyer of American debt on the planet. More consistent than China. More predictable than the Saudis. More loyal than any ally America has ever had. Through every crisis, every recession, every war, Japanese institutions kept buying treasuries. The relationship was so stable that economists stopped modeling Japanese demand. They just assumed it would always be there.
3 days ago,
Ministry of Finance data confirmed what the bond market already suspected. Japan isn't coming back. The 40-year relationship between Tokyo and Washington, the financial architecture that allowed America to run permanent deficits without consequence, is over. And the dollar is now running out of buyers. Here's what they're not telling you. On January 15th, at 6 a.m. Tokyo time, the Bank of Japan released its quarterly International Investment Position Report. Buried on page 47, in a table formatted to obscure rather than reveal, was the number that changes everything. Japanese holdings of U.S. Treasury securities had fallen from $1.27 trillion in March 2025 to $378 billion in December 2025. $890 billion. Gone. Not shifted to other dollar assets, not moved to agency bonds or corporate debt, converted to yen, euros, and gold, removed from the American financial system entirely. The report received almost no coverage in Western media. The Wall Street Journal mentioned it in paragraph 11 of a broader story about currency markets. Bloomberg published a brief item that focused on yen volatility rather than the Treasury liquidation. The New York Times didn't cover it at all. But the bond market knew. At 7:15 a.m. Eastern on January 16th, the moment Asian trading desks processed the implications, the 10-year Treasury yield spiked 23 basis points in 40 minutes. By noon, the Federal Reserve had activated emergency swap lines with the European Central Bank and the Bank of England. By market close, the Treasury Department had canceled a scheduled 20-year bond auction, citing technical considerations. Technical considerations. That's government language for, we don't have enough buyers. The mechanism is mathematical, and the math is now terminal. Japan's Treasury purchases weren't charity. They were a consequence of trade flows. Here's how it worked for 4 decades. America bought Japanese cars, electronics, and machinery. Dollars flowed to Japan. Japanese corporations exchanged those dollars for yen to pay workers and suppliers. The Bank of Japan accumulated the dollars. Rather than let them sit idle, they bought treasuries, earning interest while maintaining the exchange rate relationship that kept Japanese exports competitive. The system was self-reinforcing. American consumption funded Japanese industry. Japanese industry funded American debt. American debt funded more consumption. Round and round, decade after decade, with Treasury yields staying low because Japanese demand was always there. The system required one condition, that Japan needed to suppress the yen to remain export competitive. That condition no longer holds. This is where the lie becomes unsustainable. Japan's economy has transformed over the past decade. They're no longer primarily an export economy. Services now represent 69% of GDP. Their population is aging and shrinking, reducing domestic consumption and increasing the need for yield on pension assets. Their currency has been deliberately weakened for so long that imported inflation is now crushing household purchasing power. The yen fell from 110 to the dollar in 2021 to 158 to the dollar by late 2024. That's a 30% devaluation. For an island nation that imports virtually all its energy and most of its food, that devaluation translated directly into price increases. Rice up 23%, electricity up 41%, gasoline up 67%. Japanese citizens were paying for America's low interest rates through their grocery bills. The political pressure became insurmountable. Prime Minister Tanaka's government, already fragile after the 2025 election, faced a choice. Continue subsidizing American borrowing while Japanese pensioners watched their savings evaporate, or defend the yen and accept whatever consequences followed. They chose to defend the yen. And the only way to defend the yen was to sell dollars. $890 billion of sales later, the yen has stabilized at 119 to the dollar. Japanese import costs have fallen 25%. Household budgets are recovering. The political crisis has eased. and the American bond market has lost its largest, most reliable buyer. When institutions behave the way Japan just behaved, they're not sending signals, they're recognizing reality. The Bank of Japan's selling wasn't impulsive. The pace, roughly $80 billion per month over 11 weeks, indicates careful, planned liquidation, designed to minimize market disruption while achieving a strategic objective. That objective wasn't just yen stabilization. The pattern of selling reveals something more significant. Japan didn't sell uniformly across the yield curve. They concentrated sales in the 5-year to 10-year maturity range, the exact instruments that the Federal Reserve needs foreign buyers to absorb. They retained positions in shorter-dated bills, which can be liquidated quickly if needed. They shifted into gold, euros, and yen-denominated assets that provide yield without dollar exposure. This is what repositioning looks like, not panic selling, strategic exit. At 3:30 a.m. Eastern on January 18th, the Federal Reserve Bank of New York executed an unscheduled $156 billion repo operation. No announcement, no press release, just a sudden injection of liquidity into a market that had begun seizing. The primary dealers, the 24 institutions authorized to trade directly with the Fed, had reported difficulty finding buyers for Treasury inventory. Without the Japanese bid, the market's largest consistent source of demand had disappeared. The remaining buyers, pension funds, insurance companies, foreign central banks, weren't sufficient to absorb the supply. The Fed became the buyer of last resort, again. Less than 96 hours after the Japanese data published, the Federal Reserve had effectively reversed 3 months of quantitative tightening. The balance sheet reduction that was supposed to be running on autopilot crashed into the wall of Japanese selling. The last time the Fed had to intervene this aggressively in the Treasury market was March 2020. What followed was $4 trillion in money printing and inflation that peaked at 9.1%. The pattern is repeating. The only question is scale. While one side sells, the other side prints. The asymmetry between Japanese selling and Federal Reserve buying reveals the true state of dollar demand. In a healthy market, Japanese sales would be absorbed by other buyers. Yields would rise modestly, attracting new investors, and equilibrium would restore itself. Markets are supposed to clear. This market isn't clearing. Every Japanese sale requires a Federal Reserve purchase. The private market cannot absorb the supply at current yields. And raising yields to attract buyers creates its own catastrophe. The interest expense on $34 trillion in federal debt is already $1.2 trillion annually. At 6% yields, that expense doubles. At 8%, it consumes the entire discretionary budget. The Fed is trapped between two impossibilities: let yields rise and trigger a fiscal crisis, or buy the bonds themselves and trigger an inflation crisis. Japan just removed the third option, finding another buyer to solve the problem. The geopolitical cascade is accelerating. Japan's exit from treasuries isn't happening in isolation. It's happening alongside Chinese selling, European rebalancing, and Gulf state diversification. China's treasury holdings have fallen from $1.1 trillion to $749 billion over the past 3 years. The UK, which serves as a financial intermediary for various sovereign investors, has reduced holdings by $180 billion. Belgium and Luxembourg, similar intermediary jurisdictions, show combined declines of $95 billion. Add Japan's $890 billion liquidation, and the picture becomes clear. Every major foreign holder of treasuries is reducing exposure, not gradually, aggressively. The BRICS framework provides alternative destinations for these flows. The Shanghai Cooperation Organization's financial integration protocols allow member nations to hold reserves in a basket of currencies and commodities rather than dollars alone. The New Development Bank offers infrastructure financing that doesn't require dollar intermediation. The cross-border interbank payment system processes $14 trillion annually, up from $7 trillion 2 years ago. The infrastructure for a post-dollar world isn't theoretical, it's operational, and Japanese capital is now flowing toward it. At 11:45 p.m. Tokyo time on January 19th, the Government Pension Investment Fund, the largest pension fund on Earth with $1.6 trillion in assets, announced a strategic reallocation. Dollar-denominated fixed income would be reduced from 35% of the portfolio to 15%. Gold allocation would increase from 2% to 8%. Yuan-denominated assets, previously zero, would rise to 5%. $1.5 trillion in pension assets, repositioning away from American debt. The signal to other institutional investors is unmistakable. Japan's largest, most conservative investment institution has concluded that dollar assets carry unacceptable risk. The trap has no exit. Every Federal Reserve response to Japanese selling makes the underlying problem worse. Buy the bonds to prevent yield spikes, and you expand the money supply, devaluing the currency that foreign holders are already fleeing. Let yields rise to attract buyers, and you explode the deficit through interest costs, requiring even more bond issuance. Implement yield curve control, capping rates through unlimited purchases, and you guarantee inflation while announcing to the world that the Treasury market is no longer a market at all. Japan tried yield curve control. It lasted from 2016 to 2024. The policy held rates at zero, while inflation rose to 4%. The result was the yen collapse that triggered the Treasury selling in the first place. America is now walking the same path Japan just abandoned, except America cannot devalue against itself. There is no external release valve. The pressure accumulates until something breaks. The mathematics of the situation are now unavoidable. Annual Treasury issuance required to fund the deficit, $2 trillion. Annual Treasury redemptions requiring rollover, $8 trillion. Total supply, $10 trillion per year. Foreign central bank demand, declining by $400 to $500 billion annually based on current trends. Domestic institutional demand, flat, constrained by regulatory requirements and yield targets. Retail demand, negligible for Treasury securities. The gap between supply and demand is approximately $1 to $2 trillion per year. That gap must be filled by the Federal Reserve or not filled at all. If the Fed fills it, they print $1 to $2 trillion annually. That's monetary expansion of 5 to 8% of GDP. Inflation doesn't stay at 3% under those conditions. It accelerates. If the Fed doesn't fill it, yields rise until private buyers appear. The historical yield required to attract sufficient private demand during periods of low foreign buying is 8 to 10%. At 8% yields, federal interest expense exceeds $2.7 trillion, larger than all current spending combined. There is no mathematical solution that doesn't involve either inflation or fiscal collapse. The only question is, which pathway the system takes. The dollar index tells the story the headlines won't. Since January 15th, the day the Japanese data became public, the DXY has fallen from 108 to 101. That's a 6.5% decline in 9 days. For context, the dollar fell 7% over the entire year of 2023. The move accelerated yesterday when the Bank of Japan announced they have no intention of resuming Treasury purchases for the foreseeable future. No ambiguity, no hedging, a direct statement that the 40-year buyer has permanently exited. Gold responded immediately, $3,847 per ounce, up $312 since the Japanese announcement. Bitcoin breached $89,000. The Swiss franc hit a 30-year high against the dollar. Every alternative store of value is pricing in what the Treasury market is trying to deny. What the informed understand is that Japan's selling isn't the cause of the crisis. It's the revelation of the crisis. The Treasury market has depended on artificial demand for decades, central bank purchases, regulatory requirements forcing institutions to hold risk-free assets, the petrodollar recycling that required oil exporters to park profits in American debt. Each source of artificial demand has been weakening. Japan's exit simply removed the largest remaining pillar. What's left is a market that must attract genuine voluntary buyers at yields the American fiscal situation cannot afford. The pension funds repositioning into gold aren't speculating. They're recognizing that a fixed supply asset provides something Treasury bonds cannot: protection against the devaluation that's mathematically required to address the debt spiral. The central banks accumulating metal at record pace, China, Russia, Poland, India, Turkey, Singapore, aren't making an ideological statement. They're making a balance sheet decision. Assets that can be printed offer different risk characteristics than assets that cannot. The divergence between paper assets and physical assets isn't a trade. It's a recognition of fundamental category difference between promises and possession. This is what a system looks like when it loses its marginal buyer. Not collapse. That happens later. First comes the slow recognition that the structure depends on assumptions that no longer hold. Japan assumed that American consumption would keep generating dollars for recycling. America assumed that Japanese buying would keep generating demand for debt. Both assumptions held for 40 years. Both assumptions have now failed. The 10,000 yen note in your hand is still worth $64. But the exchange rate that produces that number is no longer stable. The Treasury market that denominates global finance is no longer clearing. The buyer that backstopped American borrowing for 6 decades is no longer buying. $890 billion. That's not a number, it's a verdict. A verdict rendered by America's closest financial ally after 4 decades of loyalty, upon reviewing the mathematics and concluding that the position was no longer tenable. When Japan sells, they're not predicting collapse. They're observing that the conditions which made holding sustainable no longer exist. They're protecting their citizens. They're preserving their options. The Federal Reserve will print what's necessary to prevent immediate crisis. They have no choice. But every dollar they print to replace Japanese demand dilutes every dollar already in existence. The currency that prices global trade becomes worth less with each intervention. This is not theory. This is arithmetic. And arithmetic doesn't negotiate. The dollar's 40-year privilege, borrowing without consequence, spending without constraint, deficits without discipline, depended on a world that kept demanding dollars faster than America could print them. That world ended on January 15, 2026, on page 47 of a quarterly report from Tokyo. The question is not whether the system adjusts. It's adjusting now, in real time, with every treasury auction that requires Fed support, every foreign reserve report showing reduced dollar holdings, every gold purchase by central banks that once held treasuries instead. The question is, who understands the adjustment while there's still time to position for what comes after? Who recognizes that the denominator is changing and recalculates their wealth in units that don't depend on printing? Japan understood. They sold. Reality is asserting itself now. It doesn't wait for permission. It doesn't pause for policy responses. It simply reveals what was always true beneath the surface of numbers that no longer add up. $890 billion, 40 years of loyalty, gone in 11 weeks. The marginal buyer has left the building. What remains is arithmetic, working itself out in the only way arithmetic knows how.